Management Skills Part 2. How to Run Money at Every Stage of Life? At around 12 o'clock at night, a guy was sitting in front of his laptop. The salary slip was open on the screen, and the education loan file was lying on the table. His friends' travel photos were shining in his phone. The mind was saying life is right now, enjoy it. But the loan statement was asking, what about the future? The fear begins right here. If everything is spent today, what will happen tomorrow? And if everything is saved today, will life remain just a calculation? In part 1, we saw that the financial brain is not always logical. Money is seen in numbers, but decisions come out of emotions, fear, greed, and comparison. We understood that loss aversion scares us so much from loss that we sell investments at the wrong time or hold on to a bad decision just to save our ego. The biggest lesson of part 1 was exactly this, that before managing money, one has to manage one's own behavior. Budget, net worth, and the pause rule are not just tools, but ways to handle the brain. Now the question moves forward. If we have come to know that our brain can deceive us in matters of money, then how should money be managed in the different stages of life? This is the very place where managing money with life cycle theory comes into our story. This theory says that money planning should change according to age, income, and responsibility. The financial life of every human being is not the same. A 22-year-old student, a 30-year-old employee, a 40-year-old parent, and a 60-year-old retiree cannot run on the same saving rule. Many people advise to save 10% of the income. To hear it, this rule looks simple, but the life of every human being does not run by a simple formula. If someone's income is low, rent is high, there is family responsibility, or an education loan is going on, then even a 10% saving can become pressure. And if someone's income is very high, expenses are under control, then just a 10% saving might even fall short for the future. Therefore, it is necessary to look at reality before the rule. The core idea of the life cycle theory is that a person decides spending and saving, looking at their entire lifetime. Taking a decision just by looking at today's income is incomplete. When we are young, income is low, but energy is high. Studies, skills, networking, travel, and exposure can change the future income at that age. Therefore, saving every rupee at a young age is not always wisdom. Many times, spending on the right course, the right city, the right experience, and the right learning can increase the earning power of the future. But this does not mean that careless spending is right at a young age. The theory gives permission for enjoyment, not for irresponsibility. The difference is very big. If a student takes an education loan and learns a valuable degree or a strong skill, then that is not an expense, it can be a human capital investment. But if that same loan is taken for a luxury lifestyle, then there is danger. Human capital means your earning ability, your skills, education, health, communication, and decision power. This is the very first asset which is made before any Demat account. Suppose a 25-year-old person is in a new job. The salary is limited, but the possibility of growth is good. If he suppresses every happiness and only does saving, then life can become dry. But if he blows the entire salary on showing off, gadgets, and weekend parties, then the future will become weak. Life cycle theory shows the middle path. This theory says do not completely sacrifice today, but do not ignore the future either. Make spending meaningful and increase saving along with income growth. When income increases, the biggest trap is lifestyle inflation. The salary doubled, so the rent doubled, car bigger, dining expensive, and subscriptions became premium. If the lifestyle eats up the entire money as soon as the income increases, then the promotion turns just into a show-off. Wealth is made when income increases, but habits remain a little in discipline. This is the very point where the financial brain of part 1 returns again. The brain will say, now you deserve it. But the plan will ask, is the debt finished? When a promotion comes, a bonus is received, or business profit increases, then first the old loans, emergency fund, and investment bucket should be made strong. Enjoyment should happen too, but not on the entire money. Life cycle theory teaches us guilt-free living too. Money is not just a thing to be accumulated. Money is a tool to support life. If you kill every happiness of today just in the fear of the future, then it is possible that the bank balance might increase, but the warmth of life might reduce. But if you forget the future just in today's fun, then one day that same future will stand at the door becoming a bill. Balance alone is the real money skill. Now see this theory in Indian life. In the initial career, there are rent, transport, parent support, and loans. In mid-career, marriage, children, home loan, and insurance get added. Then a stage comes where income can be at its peak. This very time is most important for the retirement corpus, children's education planning, and debt reduction. After retirement, income can reduce or stop, but expenses do not finish. Some expenses decrease, some increase, especially expenses connected with health. Therefore, life cycle planning means choosing the right priority at every age. Skill and stability in young age, protection and wealth building in middle age, income safety in later age. Now the talk comes to investment. Many people get scared the moment they hear the word investment. They feel that this is a game only of experts, charts, and complicated terms. In reality, basic investing starts with a very simple idea: putting the money that you do not have to spend today into such an asset that will help you in the future. But every single money should not go into investment. First, liquidity will have to be understood. A liquid asset is that money or asset which can be quickly changed into cash when needed. Bank balance, emergency fund, short-term deposits, or money market type options can give liquidity. Their job is not to make you rich but to save you from panic. If a medical emergency suddenly comes, the job goes, or a big repair happens in the house, then liquid money becomes your first wall. This is the safety layer. Liquid assets look safe, but growth can be limited in them. Inflation can slowly reduce the purchasing power of money, therefore keeping the entire money in cash is also not smart. On the other side, stocks, bonds, mutual funds, or long-term assets can give growth, but along with them comes risk too. Here, patience and understanding become necessary. To understand a bond in simple language, you lend money to some government or company and in return expect interest. Risk depends on the issuer. In a stock, you become a small shareholder in the company. If the company grows, then your investment can increase. But if the business falls weak, then the value can fall too. This is the reason why, before putting money in the stock market, understanding is needed, not excitement. An investment should not be made just because some company is famous. Many times, a famous company is already expensive. The expectation of growth in it can already be included in the price. Therefore, making an investment looking at the name is not always safe. A common mistake of new investors is that they want immediate profit. They understand investment not as farming but as a lottery. They want to see the crop the next day after sowing the seed. The market does not run like that. A good investment needs time. And if the investment is wrong, then even giving it time does not make a miracle happen. Therefore, both selection and patience are needed. Here the need for diversification arises. Diversification means not putting the entire money in one single place. Dividing money among different assets so that one mistake does not shake the entire life. If the entire money is put in one stock, then your future has become tied to the fate of that company. But if the money is in different assets, the risk spreads out a little. Diversification does not give a guarantee that loss will not happen, but it reduces the chance that one bad decision spoils your entire financial journey. In a simple portfolio, there can be separate buckets according to liquid money, bonds or fixed income options, equity exposure, and long-term goals. The mix will depend on your age and risk capacity. A young investor can take more risk because he has time. But this does not mean gambling. A long-term horizon gives the ability to absorb risk. It does not give permission for foolishness. An older investor needs stability more because the time for recovery is less. A person close to retirement might have to give more attention to income safety and capital protection. The most important question in investment is, when do I need this money? If the money is needed in 6 months, then putting it in a risky stock can be dangerous. If the money is needed after 15 or 20 years, then a place can be made for growth assets. The time horizon is the biggest filter of an investment decision. The second question is, if the value falls, will I be able to handle it emotionally? Risk tolerance is not just math, it is a sleep test too. If your sleep disappears as soon as the market falls, then the portfolio is not yours, it is made of someone else's advice. Only that investment is right which you can hold after understanding. In part 1 we learned the pause rule. In investment 2 that same rule comes in use. Do not put money immediately upon seeing some hot tip, viral video or guaranteed return. Scams often create urgency. They say if not done today, the opportunity will go away. A genuine investment never stops your breath, it gives you time to think. It is better to start with a small amount. In the beginning, the goal should be to learn investing behavior, not to double the money. The market introduces you to your own emotions. When you put in a little money, see a drop, see recovery and understand your reaction, then you start becoming an investor. A good investor always keeps learning. He does not consider a loss a personal insult and does not understand profit as proof of his genius. He looks at both like feedback. Life cycle theory and basic investing together tell us only one thing: money is not static. Your age, income, goals and responsibilities will change, therefore the plan should change too. Today, if you are young, build skills, understand debt, and avoid a careless lifestyle. If you are in mid-career, make protection, saving rate, and investment discipline strong. If you are close to retirement, do not run just behind returns. Give attention to income stability, health planning, and safe withdrawal. Money now should not just grow, it should support too. The real lesson of this part is that saving is not the purpose of life, and spending is not the enemy. Wrong spending at the wrong time and investment without understanding is the real danger. Money becomes meaningful when it fits with your life stage. Growth in young age, balance in middle age, and security in later age. Now the story stops here, but a new question stands in front. If we have got a basic understanding of stocks, bonds, cash and diversification, then what is the real game inside financial instruments? Which instrument comes in use in which situation? Which one gives you safety, which one growth, and which one becomes a trap just with an attractive name? In the next part, we will lift this very curtain. Because in the world of money management, products are many, but the right product is only that which truly fits with your life, risk and goal.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.